This is the Economic Club of Florida, a distinguished platform for discussion of the major national issues of the day. On today's program, economist Jeffrey Roach of LPL Financial on the 2023 economic outlook for the nation and Florida.
Florida often outperforms the rest of the country, whether it's during downturns or whether it's during growth periods. And part of that is because in more recent years, Florida has become more diverse economically.
Good day and welcome to the 564th in our series of distinguished speaker programs. I'm Harvey Bennett for the Economic Club of Florida. We kick off the new year of 2023 with a look forward at the financial markets and the broader economy. We're very happy to have with us Dr. Jeffrey Roach, Vice President and Chief Economist for the Investor and Investment Solutions Group at LPL Financial, which is an independent brokerage firm. Dr. Roach, welcome.
Well, it's great to be with you today. Thank you for having us.
Well, tell us more about what LPL is and specifically what you do.
Well, we're the largest independent broker-dealer in the country, and so we service independent advisors, so wealth management firms that want to clear outside of the major wirehouses like Wells Fargo or Merrill Lynch. They want to be independent. We are there for them.
So that's an alternative to the big traditional model of brokerage houses.
That's right.
And tell us a little more about how you pass your day.
Right. So we exist to serve our clients, and our clients are wealth managers across the country. And one way in which we service them is to provide cutting-edge research, market research, economic research, to help them help their clients, the end investor. And so I'm part of that research group, and we are spread around. We have offices. Part of our team is in Boston, a few in San Diego. Most of us are in Fort Mill, South Carolina, which is just over the border from Charlotte, North Carolina.
Absolutely. So you folks are the strength behind the independent financial advisors of the country.
That's right.
Very good. Well, I don't want to spoil your upcoming address before the Economic Club, but perhaps can you give us a couple of takeaways that we'll get from your presentation as it relates to the global financial markets and the broader economy?
Right. So there are a couple things that are quite interesting, to say the least, right now. Here we are going into 2023. A lot of us are talking about the rising risks of recession. I'm going to talk a little bit about the tug-of-war between the markets and the Federal Reserve. So the Federal Reserve says, hey, we're going to keep tightening in the next couple of meetings and then hold steady for the rest of this year. The markets have clearly priced in the fact that the Fed will most likely cut rates the latter half of 2023. And so I'm going to talk about the problem and who's right. Are the markets right, or is the Federal Reserve right?
And I guess who ultimately will end up. But I know you don't have a crystal ball. That sounds fascinating because of the recession, certainly inflationary costs. There's a lot that I'm sure goes into your figuring and your analysis. Bringing it to Florida, Florida's economy has sustained tremendous growth over the past 8 years or so, especially. I mean, we've been on an upward trajectory for a couple decades, but it seems it still tends to be viewed by investors as a nice place for tourism and real estate, but we don't have California's Silicon Valley or Boston's Route 128 tech corridor. With tech a big part of the future, Dr. Roach, how do you view that?
Well, I think the hybrid work environment is fantastic for Florida. So you have the opportunity to move to a place that has fairly attractive standards of living, tax structures, fairly favorable. And so the opportunity is there for folks to move into the state. We actually are seeing that. I think one of the things I'll highlight during the talk at the meeting today is the fact that Florida often outperforms the rest of the country, whether it's during downturns or whether it's during growth periods. And part of that is because in more recent years, Florida has become more diverse economically. And I'll highlight that in our talk in just a little bit.
That sounds terrific. Dr. Jeffrey Roach, Vice President and Chief Economist for the Investor and Investment Solutions Group at LPL Financial, Thank you. We look forward to hearing your upcoming address and discussion on 2023 global markets and economic outlook.
A lot to discuss. Looking forward to it.
Now, here's former Economic Club Chair Bill Moore, president of Capital City Trust Company, with our formal introduction.
I'm excited to have Dr. Jeff Roach with us today. He's been with LPL about a year. And before I talk about Jeff, I just want to tell y'all who LPL is, because you're probably wondering, who the heck is LPL? Because they try and keep they're in the background, but they are one of the largest independent broker-dealers in the country and have over 21,000 advisors in the United States, some of which are in this room today. There's about a half a dozen as I look around. And there's actually 1,100 financial institutions. I gave Ben an incorrect number this morning when I told him 800, but there's 1,100 financial institutions that LPL works with. Something that is probably appropriate for people in this room from Tallahassee that Jeff may not know, since he's been with LPL a year, is the CEO of LPL is Dan Arnold. Dan started in January of 2017. The stock price was about $35. Today it's trading around $225 a share. Dan went to McClay. He we played basketball together in middle school, and he is one of the, he's the CEO of a Fortune 500 company today. So Dan's done a great job. He's a friend of mine, and I'm glad to have LPL as a partner. And again, I'm thankful that Jeff is here today. I think that he may have had his arm twisted to come to Tallahassee. He's a Clemson guy, and it may have something to do with there's a couple of members of the LPL Ambassador Council here. I'm on the Ambassador Council for financial institutions, and Kate Clark is on the Ambassador Council for the Independent Channel. So, Jeff, welcome to Tallahassee. He's the, as you heard earlier, and you have in your material on the table, he's the chief investor. Is the chief economist in the Investor and Investment Solutions Group at LPL Financial. He serves as a voting member of LPL's Research's Strategic and Tactical Asset Allocation Committee, a mouthful, where his ability to relate to economic conditions with financial market outcomes is highly valued. His broad experience as an institutional trading floor and portfolio management make him an engaging speaker. We're hopeful, Jeff. Which I'm going to digress from these printed remarks to tell you that I really wanted to find a joke on Economist. And I asked Alexa this morning 4 times for a joke on Economist. She never gave me one. Thank you. Prior to his current role at LPL, Jeff was senior economist with Visa, where he focused on macroeconomic forecasting for both internal stakeholders and external clients who were in a diverse set of industries. He started his career as senior economist on Bank of America's corporate trading floor. While on Bank of America's corporate trading desk, his group was responsible for internal economic research that was closely guarded and periodically sent to FOMC officials. In order to facilitate cutting-edge research, Jeff maintains frequent contact with Federal Reserve economists, Wall Street analysts, and other leading economists from around the world. He's a contributor to the financial press as well as a sought-after speaker, and has presented economic research as far away as Italy's Ministry of Finance in Rome and Office of National Statistics in the UK. He has a PhD and an MA in economics from Clemson and a BS in mathematics from Bob Jones University. He also received a visiting research appointment at Harvard University. I welcome you, Dr. Jeff Roach.
So I didn't get a fun fact in my introduction, so I'll go ahead and share one. So I came to Tallahassee, my first time being in Tallahassee, and I came out of that period of time, after Thanksgiving and Christmas, New Year's. I did not look like an economist. I desperately needed a haircut. My wife was texting me. I can show you proof here. She was texting me probably every hour, "Did you get a haircut yet?" So fun fact for me is after I landed in Tallahassee, I got a haircut at the Chop House, and then I went across the street to get a local coffee at the, what is it? Lucky Goat Cafe. I got that right this time. And it was good coffee. I come from Charlotte, and so just down the road is Raleigh. Raleigh has counterculture. So if you're a coffee snob, you have Larry's Coffee and counterculture, which is good coffee. But I'm here to talk economics, not haircuts or coffee. So very, very happy to be here. I'm gonna go fast. We have a mic right there in the middle of the room. So I love Q&A. So what I'll probably do, if it's okay, I'll just go straight from my talk to Q&A. So I'm going to make sure that we have plenty of time to get to your questions. I can share with what I think is important, but you have questions too. So we'll make sure that that's ready to go. So I'm gonna start and talk a little bit about what I think are my 4 hot topics. There are a host of hot topics, but this captures most of them: inflation, recession, Fed, real estate. The reason why real estate's in there is because it's so helpful to be a market historian. Think about where are we relative to previous cycles. I started my career in 2004. I remember distinctly questions from traders at Bank of America saying, "Hey, you're the new PhD guy. Can you go research this thing called a collateralized debt obligation?" That was 2004. So it's good to know context. Where are we now relative to previous cycles? That's why it's good in this business to have a little gray hair, because then you've known what it's like with the ups and downs and things. So that's why real estate's up there. I think it has an interesting connection, an interesting storyline relative to where this country's been in previous business cycles. So that's the roadmap. And after each of these 4 hot topics, we're going to kind of come up for air, and I'll have a slide with just kind of a snackable bullet point. So when you leave the room, kind of like the commercial at the beginning, you had your 3 points, you leave the room, and you'll have something to continue the conversation. But economics, it's the dismal science. Hence, that's why the room's lights were lowered a little bit, I think, before I talked. It doesn't have to be dismal. You can tell how I approach it. It's a wonderful way to study human behavior. It's studying our culture. That's what economics is, and how it relates to markets. So it's not dismal, but here are my 4 points. But before we get to that's our roadmap. I do want to introduce a couple, what I think, interesting takeaways for Florida. So my experience with Florida has been all over the place. I have a cousin who still lives down here, but I had a sister and brother-in-law who lived in Miami, and I had no idea that when we were at a nice after-dinner drinks at the Mandarin Oriental Hotel downtown Miami, that all of a sudden everybody just jumped up and started dancing to Enrique Iglesias Bailando. And I thought that was my first experience, and I said, well, I can do this. I like this, and I'm glad you didn't know me then. I've also enjoyed coming down to grouper fish with my cousin in Newport Richey, just north of Port Richey, north of Tampa. And then of course, driving through, I shared a little bit with this. My kids are big readers, and we focus a lot on the classics. One of them is called The Yearling. Anybody know that classic book? Yes. So here we are in 2022. Last year, my young kids were reading The Yearling. Of course, it's based in Central Florida. So Florida is incredibly diverse, from bailando to grouper to hog hunting in Crystal River. I was telling my new friend here about hog hunting that we enjoyed. And then, of course, you have Central Florida, very diverse. I want to tell you a little bit about Florida. So this is from the Bureau of Economic Analysis. And just to put in perspective, after California, I spent my time in Silicon Valley, and then I got right and came back to the Southeast. So California, New York, Texas, Florida. Florida's number 4. And in fact, there's quite an interesting way to look at Florida. And, it consistently, that's my little tagline here, consistently outgrows the nation. So this is just year-on-year job growth. And it's not just post-COVID. If you want to look at this, I'm going to test my laser here. You got my laser. You can kind of see it over there, right? So really, even before COVID, employment growth in Florida has been fantastic. Think about that period, kind of the Great Moderation, we call it. Pre-Great Financial Crisis, this is about when I was researching CDOs and collateralized loan obligations. There's Florida again. So and these gray areas are just signifying recession in this country, and it goes back all the way to the 50s in this graphic. But it just shows you that Florida's been a consistent outperformer. And one of the reasons why it is because Florida is amazingly diverse. So you're Florida residents, most of you, at least you live here, wherever your residence is, but most of the folks that are outside, particularly Californians, because what I learned living in Silicon Valley is the world truly revolved around them, and so there really wasn't anybody else outside of Sunnyvale and Cupertino and San Mateo. That's where my office was. But Florida benefits from a fairly diverse economy. So you think about the U.S., Florida providing a lot of citrus for the nation, but would you believe that one of the main exports, the top export for Florida, is meat? Of course, those that might have connections to agriculture know about that. But people in Miami probably don't know that. So it's quite diverse, and I think that's helpful to think about because that explains a little bit of that, shall we say, kind of a diversification in the growth of the state. So here's just a graph of this is not job growth. That was my previous graph. This is just private industries. So we're talking everything from housing, from the sciences, the healthcare, the services, manufacturing. This is private industry growth, and really, it's been a good decade. Again, you think about going into the Great Financial Crisis, the 08-09 period, and everything's below the zero line because we're in recession. But you think about how clearly getting hit with a heavy real estate story. Right, that was all about, when you think about 08, if you could fog a mirror, you got a mortgage. That's very different this time around, and hence we'll talk about that, what's similar, what's different this time around. And of course, Marco Island, had friends who had real estate in Marco Island. Very difficult time during the Great Financial Crisis. A little different scenario this time around. You see the blue is Florida, a little bit less of a hit during the massive government shutdown here of businesses. But you think about coming out of it, and again, even during the Great Moderation, the blue line there, Florida has had fairly steady growth that outpaced the U.S., particularly because of its diversification. Let's do one more thing, and then we'll get into my 4 hot topics. And I think this relates a little bit to the real estate story, but the hybrid model that businesses are doing. So I work, whenever, really LPL's model is be great from anywhere, and I love that. But I work in my home office, work in my corporate office, and that hybrid work environment allows, I think, for so much flexibility, and I think that explains a lot of this. This is the real estate side. So this is just real estate rental and leasing activities in Florida, which is the blue line, relative to the country as a whole in the orange line. And I think if you want to think about, okay, what's the expectations for 2023, 2024 going forward, I think it's fair to say that there's sunshine days ahead for the Sunshine State. So let's go back to the 4 hot topics. First is inflation. So we know it's a story. We know it's a terrible story, particularly for some parts of the country relative to others. So I think the big takeaway that I want to talk to you about with the inflation story is a lot of our inflation metrics are connected to housing, right? So we have roughly 1/3 of the CPI, Consumer Price Index, that's tied to outright rents or an imputed value called owner's equivalent rent, meaning I'm one of the several folks that left the West Coast, came back to the East Coast. I moved out of Silicon Valley in December 2020. And so I was leasing in Silicon Valley, and I moved from leasing to owning. 2.5%, before things got crazy, got below asking price, which is unheard of, at least going into 2021 and 2022. So inflation in my household experience is very different than someone who didn't transfer to a fixed rate mortgage. If you had a fixed rate mortgage, your housing costs have not changed much. Now, granted, utilities are part of that, right? So that could change. Food clearly has changed in terms of pricing and some of the others. But 1/3 of the CPI metric could be a moot point for you if you have a fixed rate mortgage. So what I'm doing here is I'm just showing you it's helpful to know your audience, whether you're working with clients, whether you're talking to a colleague, the office, talking to family over a meal. Inflation is highly particularized. My inflation isn't your inflation, as it were. And that's because if you think about it, here we are, 65% of Americans are homeowners. I think that's extremely important to think about. But let's go a little bit deeper, though. So I think we're past peak inflation. We're convincingly past peak inflation. And we're actually seeing some pretty decent, encouraging signs in just about everywhere except rents. And I'll talk about that in just a little bit. So this is showing you the difference between two really popular metrics for inflation. And I'm going to apologize right off the bat again if you're feeling like you're in Econ 101. So at Clemson, with my apologies, you weren't supposed to say anything about Clemson because I know my audience and I wanted to avoid that. But I had the distinct privilege of having football players in my class. As a graduate student, what happens is, the professors say, just put the graduate students teaching that class because I don't want to waste my time. So I'm very used to people sleeping in class. So if I'm used to seeing the other side of your eyelids, but I'm apologizing if I feel like you're in Econ 101, but if you sleep, I'm not offended. I'm used to it from the football players. But here we are. So two things you want to think about. So there's a CPI metric, Consumer Price Index. There's another inflation metric that's actually the preferred metric for the Federal Reserve, and that's called the deflator, the Personal Consumption Expenditure Deflator. So we like acronyms. That's why you see PCE deflator, meaning that the Fed says, all right, you're looking at inflation. We're trying to measure it. It's very difficult because my inflation is not your inflation. We don't want a fixed basket of goods and tracking prices over time. That's the CPI, right? So if you're a fruit person and apple prices go crazy, you're going to switch to bananas, right? You're going to substitute as relative price changes. The CPI basket of goods is fixed over a 2-year period. So the Fed says, hey, we need to get a little bit better on that. The Personal Consumption Expenditure Deflator is real-time spending. And the relative to what you're actually spending, how are those prices change? It allows for that substitution. That's why it runs a little softer. Hence, I put the dotted lines on the Consumer Price Index, and then I have the solid lines on this deflator. Either way you look at it, inflation's past peak and easing. I think we're going to get to close to the 3% handle by the end of this year. Hence, that's why I have that forecast for 2023. And I think that it's going to be convincing, particularly as more multifamily units come online. And we'll talk about that in just a second. So I won't. This is a lot of text here. This is a dashboard that I put out for our clients and advisors and folks. So you can see this on my social media account and the research we do. But it basically says, okay, what are all the ways in which we can measure price changes? Import prices, producer prices, what are purchasing managers saying about input costs? What about gas prices? All these kind of things. That's why I call it my dashboard. Green is good, red is bad. And so the takeaway from this chart is not memorizing each line item, but green is good. There's December 2022. And then red is the owner's equivalent rent, as I just talked about, the rental prices. Everything else looks amazingly green. So here we are. Back up above the waterline, hot topic number one, inflation. Inflation hits lower income households harder. Remember that inequality component. It's interesting, the St. Louis Fed just recently did a piece on this. I've been talking about this for about a year and a half. My colleagues started to do a little more research on the specifics of this. But the point is, inflation hits lower household. What counts for markets? So we say, okay, if you're in the investment side of the house, say, okay, what are markets going to respond? Markets respond when the direction's right. So you say, okay, 9% inflation is crazy. Well, 6% is equally crazy historically, but it's the direction and the direction that counts. So that's kind of the hot topic number one. Hot topic number two is recession. All right, we're going fast, and I think we're still going to be good for some Q&A. This is a graph of our total U.S. GDP. That's the black line. And broken out by components to say, okay, what specifically was growing or contracting over the last couple quarters? And what I'm showing you is we had 2 consecutive quarters of negative growth last year, Q1 and Q2, right? So you see Q1 and Q2 of last year, and there we go, right there, negative. But look at the green component, meaning that even though we have 2 consecutives of negative growth, that does not make a recession. That's the takeaway. Now, granted, you have to go back to the 47 era to show that it's actually happened before, but I think this is a great analogy. So think about reopenings, geographic reshufflings, hybrid, people kind of recovering, particularly supply chains. Coming out of World War II, we had this massive retooling back into private sector activity for the manufacturing side, right? So capital and labor were kind of moving about in this massive magnitude. So in 1947, we had 2 consecutive quarters. We had no recession because so many parts of the economy was actually growing. Same thing here. Part of that consumer spending, that's why I highlighted it in green there, spending on services, that green, that's still very strong in Q1 and Q2 last year. So I don't think we're in recession right now. We're very close. I don't think it started in 2022. I think it'll start early 2023. But the reason why it didn't start in 2022, because it was very similar to another period of time in this country when we had this massive retooling of capital and labor, where headline number was negative, but underlying growth in some categories was still very strong. All right, wow, that was heavy. Let's keep going. Let me go to this point, and then we'll summarize. So hot topic number 2, because I'm going to go fast here. We think the most likely scenario is first half of this year is going to be recession, contracting. People are slowing down. I wrote about this yesterday after retail sales numbers, suggesting that trajectory is going slower and slower and slower. Once it contracts, first half of this year would be negative. The latter half of this year, we could eke out some growth. Hence, we see 23 slightly above 0. We don't have 2022 numbers. You might say, hey, whoa, is this an error? You're shaded, suggesting forecast, but 2022 already ended. Well, we don't have the full Q4 estimate until just a couple weeks from now. All right. Why do we care? What do we think about in terms of markets? Well, you look at every other shock to the system, back to Black Monday, Gulf War, Asia monetary crisis, the tech bubble, financial crisis. After the shock, markets are up double digits. So this literally shows you 12-month returns after a shock of the S&P 500. This means markets respond and bounce pretty solidly after these shocks. So I think recession, hot topic here. 2 consecutive quarters do not mean a recession. we do think we're going into one in 2023. All right. So he would call us. I guess I should warn you, if I turn out to be particularly clear, you've probably misunderstood what I've said. I will say the first time Greenspan's name was yelled out across the trading floor, I thought people were joking. Greenspan's on the phone, would you pick up? And of course, there's a couple adjectives before, would you pick up? And there was actually something before the pick up, but I won't repeat it because everything you hear about trading floors is true and then some. He would call us because at B of A we had data that he wanted to look at. Remittances to Mexico, direct deposits, what were people doing, pulling money into Bank of America accounts. And so we would share a lot of the detailed economic insights that we had based on B of A data and share it with Greenspan. Well, Greenspan was an end of an era. So you think about the Volcker years, they would hike and cut, hike, cut, hike, cut. It's crazy. Greenspan was this transition year. Once we got to Bernanke, Yellen, Powell, it's about stability. They're using other tools. You don't see this stop-start activity in the current Fed than, say, back in the day. I think the markets are right. The markets are expecting the Fed to cut the latter half of this year. I think they will because we have recession risks pretty high the first half of this year. I think the Fed's wrong in saying, in their infamous dot plot of, hey, we think we're going to hike a couple more times and then hold steady. Let me kind of give you this, and then we'll keep going. So, labor market's key for what's going on right now. This is not specific to Florida, but Florida has a massive challenge with a number of job openings and not enough people to look for those job openings. So there's that ratio of openings to unemployed. In fact, the Chair Powell that likes to talk about this. Well, that's across the country. Florida, that's where I want to say, okay, is there anything negative to say? I think some of you were saying beforehand. You going to tell us anything good? Well, here's the not so good. Florida does have a challenge with just filling openings. The labor market churn, I think, is starting to slow, and I make that point because one of the most challenging sectors post-COVID was in the construction space. People could not find enough qualified workers. So you had a lot of churn, particularly in construction. That's starting to change in a massive way. So this graph right here talks about quits rates. So this is part of that labor churn that's going on. So look at the blue line. That's the quits rates for construction workers. Orange line is the quits rate for the country as a whole and in industries in aggregate. What I care about, again, is leading indicators. I don't want to talk about the past. I want to talk about where are we going, where are we heading. And I think what's interesting here is just to think about the fact that part of the signs of this churn, people moving from West Coast to East Coast, people quitting, people moving from one firm to another, you're starting to see that slow down, particularly in what I think is a leading sector, and that's going to flow through the rest of the labor market. And that's just that quit rate in construction sector. So that's kind of the story here. Fed here, here's kind of the takeaway. Don't get focused on these news bits. So the Federal Reserve Open Market Committee, FOMC, which I probably should spell out in my bio. You read the FOMC, you're like, what is FOMC? Federal Open Market Committee is made up of Board of Governors and then a rotating selection of various presidents from all the central bank branches. Like Mary Daly in San Francisco, you got Dallas, you got Neil Kashkari out of Minneapolis, you got Atlanta Fed, you got Richmond Fed, New York, Philadelphia, of course, Cleveland. So they're all out talking. Ignore it. That's my bottom line. Look at the overall financial conditions. Look at particular labor market. Look at the churn within the labor market to give you a good insight in what's happening. All right, here's the hot topic number 4, and look at that. We'll have at least 9 minutes or 8 minutes for Q&A. Keep it on track here. So what's fascinating about the real estate story is this, that there's really a tale of two economies. You have single-family homes. So this is just, look at the construction activity in single-family homes and then construction activity in the multi-family homes. So there's your apartment complexes, there's your condos. In fact, I was talking to somebody beforehand, I can't remember who it was, talking about permits and kind of the backlog of these permits. Things slowed down, particularly in 2020. But there's a lot of projects coming online for your multifamily dwellings. I think that's actually going to do great things for the rent problem that we see right in this country. But it's a tale of two economies right here in terms of real estate. Single families plummeting, possibly hitting bottom. We got permits and housing data today, 8:30 this morning, Eastern time. But blue is that multifamily, completely different story. So multifamily eventually depress rents. One thing that's out of balance, I want to leave you with, and then we'll do some Q&A. So I took a screenshot from my phone here from Cadillac of South Charlotte. And I'm illustrating to you what happens when things are out of balance and things that might get back into balance. So you can see the MSRP number is struck out here. And there's this thing that said market adjustment. So this is the Escalade V. I don't know if anybody's a fan of those, but the V is kind of like the super charged version of the Escalade. So it's it's at the top end. It sounds good. The closest I've been to it is just hearing it purr. But it's amazing. So look at the $75,000 market adjustment, meaning our inventories are too low relative to sales. We got a massive inventory to sales ratio. That's a market imbalance. What's on the flip side is general merchandising. They have bloated inventory. So I did this for some of our internal conversations when we were talking about investment things and themes where we could go. You look at inventory to sales ratio for general merchandise, it's probably double where it normally is. Meaning, okay, we ordered all this stuff when we couldn't get it. Finally, it's come. Now we have too much inventory. That's imbalanced the other way. So the theme for our 2023 outlook that, Bill, you referenced was finding balance, because it's going to take time, right, to kind of work through that. But that clearly is something you need to watch. We're starting to see in used cars, not quite. This is a new car problem. But here's the summary and then Q&A. Markets are right. Ignore the Fed. That's kind of my words. CPI convincingly cooling, tale of two economies. When you think about real estate, think U.S. over EU. You favor that because Europe is not quite at the convincing end yet in their inflation stories. And then I think, in a nutshell, the point number 5 here is headwinds of last year could be tailwinds. The inflation headwind, could it be a tailwind as it cools? Economic trajectory, this zero COVID move, and then Russian invasion. So perhaps the headwinds of last year become tailwinds of this year. So we're doing great, to quote the current chair. Thank you very much. Thanks for having me. I would love to hear from you, and it looks like we already have some people here. So,
Yes.
Oh, thank you.
And if we could just have the club members ask questions, please. Thank you.
Okay.
Go ahead. You go.
Thank you, Doctor. I'm sure you've been watching the situation with the federal debt limit. Perhaps I would like to invite you to make some comments about how that possibly might affect all of these things, as well as particularly the state of Florida. Will it have an effect?
Yep. Yeah, great question. So a couple things. Since the 1960s, the government has bumped up with the ceiling. I think it's like 78 times since the 60s. So history is important. We should all be students of history. I'm on the board of a classical high school, so I like to say things like that. Students of history, don't ever minimize the study of history. So 1917, there's an act saying, hey, you got to have boundaries, right? You can't just keep on spending what you don't have. So that was since the 1917. Mentioned just, the number of times since the 60s. The most aggressive and risky in more modern times was in 2011, I believe, August, when the Treasury was starting to exhaust all of their emergency funds. S&P downgraded our debt, S&P as a S&P 500 index fell almost 20%. Consumer confidence fell. I mean, it was pretty bad the time when we bumped up against that. So as of today, I believe it's today, right? I mean, it's average right now. The Treasury implements this extraordinary measures clause in order to say, all right, we're past our limit ceiling. We're going to use our extra, funds that we have available for these emergencies and to provide during these extraordinary measures. The real rub here in your question is, well, how long can we do that until the X date? That's what we call it in the markets. The X date, meaning that the Treasury has used up all its emergency funding. And how long can we go till the X date? I think from the data I've looked at, we could probably go till August or September. What's particularly challenging now, and this often happens when there's a divided Congress, when this even, the debate happens. You can either raise the ceiling or you can suspend it. You got those two options, right? Raise it or suspend it. But if you suspend it, I think you got 2 years or whatever. I think that happened 2019, right? There was a suspension. We didn't hear much about it. And remember, going back a little bit when I said, hey, we've done this 78 times when we bumped up the ceiling. Well, when you don't have divided Congress, you typically don't hear about it. When you do, divided Congress is often good, by the way, for markets, right? We know when you look at the graphs, divided Congress is actually good because you're reining in the profligacy of government spending. So the X date is the key to watch. The challenge, what's going to be really fun, is the fact that if you remember what I just said about the trajectory of growth, it's very weak for the first half of this year. Well, if we're going into recession and we're maybe starting to grow out of it, the latter half of the year, well, beginning of that latter half of the year is when we most likely have the X date, meaning we run out of Treasury's ability to use extraordinary measures. I think a lot of it focuses on just how businesses can handle the time when consumers are slowing down. There's just a lot less in terms of just regular activity. So one of the things, going back to the X date, one of the biggest things probably right now is watching what the April 15th, both individual tax returns, what's that going to do to provide a little more funding for government. You think about a household, the government is very different than a household in many ways, but in some ways it's helpful to remember that a lot of the spending might be a little more consistent, right? Because you have Social Security, you got military, that kind of thing, but the income side of the ledger is very, very lumpy, particularly with tax receipts. I think things could be a little more dicey this time because we're going through the extraordinary measures during a time when the economy is most likely falling in recession. So it most likely could have that same effect if no changes, right, on Fed policy or how businesses respond. If no changes, we keep the current trajectory, it could be real similar to 2011. I think that's the best way to kind of summarize it.
Thank you, Dr. Roach. Dominic Calabro with Florida Tax Watch. I think I shared this with you before. Two quick questions. One is, Florida is the third most populous state in the nation, but I see here the fourth largest economy among the 50 states. So what's the gap, and when will we close it? I presume New York is the third largest. So since we beat them in population, when will we beat them economically? A, what are the components that would do that? The second part is maybe kind of quick, maybe it's more important, the second one. What interest rate does the Feds have to impose to bring real estate, and particularly labor costs? I mean, labor costs are just skyrocketing. And it's really further impaired business with the ability to get talented folks. I can't think of a business sector that doesn't have serious problems with available talent. So will the labor costs come down? At what price point and interest rates, and also real estate prices?
Yeah, excellent. So all in less than a minute, but I think I could do it. So when will you take over New York? I think what's happening right now, given the fact that the hybrid environment is really conducive, I think, for a state like Florida that has it's a lower cost of living. Think about where I came from, right? West Coast. Lower cost of living, tax, much better tax scenario than California. And you look at the ability to draw some of the tech sector, the venture capital, that kind of money into a state that didn't have it, say, in the previous massive, great financial crisis, for example, the last 10 years, 50 years. I think the circumstances bode well for Florida to continue on, what I showed on the graphs, of outperforming the rest of the nation because of those kind of reshuffling options. The second question is interest rates, and where does that flow? So the Fed never wants to be caught with the zero lower bound problem. So you think about zero lower bounds, ZLB. That's what you kind of see, in the press and the markets. When you have a recession or weakness and rates are already at 1.5, right? You can't go much lower, right? You got that zero lower bound. The Fed's going to want to keep rates higher than, say, in the previous cycle, but they could basically pull down to, say, 3.5 again, or maybe a little bit lower. You want to stay a little bit above target rates. You want to stay a little bit above inflation rates. So the real rate is positive. I think the point there is if the Fed responds like the market's priced in, the futures market and the options market, I think it's legitimate to see the Fed cut maybe 50 to 75 basis points, almost 1%, but that might take a little bit of time to kind of get back into that. Because remember, inflation is going to hover around 4, 5, and 4 for a while. It might not be till 2024 where you'll see rates actually come down to, say, like a 3.5% rate.
Will wages ever have a downward pressure?
So this is one of the reasons why the markets rallied so much the first Friday of the month, where you're starting to see that average hourly earnings is slowing. So you're starting to see already that wages have kind of slowed down along with inflation. But you're exactly right in terms of what's the most challenging thing for small businesses particularly, and that's finding qualified workers, no doubt. I mean, I think that's, I was hearing some of you folks that work with nonprofits and education. I'm a strong proponent of thinking about the next generation, right? I mean, I have a teenager, 14, teenager at home now, and I have to say work is good. Right? Work is fundamentally good. And I think we got to do that in this country to change things around. Your question about labor market. Last question.
This is a quick one, I hope. What is your take on the inverted yield curve?
Inverted yield curve. So Cam Harvey at Duke, a colleague of mine, wrote a paper about this. Inverted yield curve, meaning that the short duration yields, 2 years yields, are higher than 10-year yields, your longer term duration. Inverted just means normally you have an upward sloping yield curve because longer duration, higher yields. It has definitely issued false positives. So that was one of the reasons why I showed a graph of leading economic indicators, which has never shown a false positive, but I just went quickly because I wanted to keep available time for Q&A. We can talk more about it. I think it has given false positives on recession. One little footnote. The question is, inverted yield curve, does it imply recession? A lot of the time, but not all the time.
There you go.
Thank you very much.
You've been listening to Dr. Jeffrey Roach, Vice President and Chief Economist for the Investor and Investment Solutions Group at LPL Financial, speaking before the Economic Club of Florida on January 19th, 2023 in Tallahassee, Florida. For more information on LPL Financial, visit lpl.com. The Economic Club of Florida promotes interest and enlightenment on important economic, political, and social issues of the day. To learn more, including how to become a member, visit our website at economic-club.com. This program was recorded at the Champions Club at Florida State University in Tallahassee, Florida.